One of the reasons I wanted you to read Gatekeepers by John Coffey was to give you an understanding that no matter how much regulation and legislation, absent an effective gatekeeping profession within the securities industry, no amount of regulation will keep the public safe. So I thought I'd go through some of the SEC enforcement procedures regarding the gatekeepers. And as you remember in the book, there's basically three gatekeeping professions: the accountants, the attorneys, and the financial analysts. In your new role in corporate compliance, or as an outside advisor, as an attorney in a firm, or in the area of risk management within the corporation, you're really going to be one of those gatekeepers. And in fact, I would argue that the gatekeeper has a higher level of fiduciary responsibility and a strong stewardship position in the modern corporation, protecting not the corporation but all of its stakeholders, its employees, its customers, its suppliers, its vendors, and the community where you live. Let's take a look at the conventional and the contemporary enforcement procedures of the SEC. So the SEC has enforcement procedures against gatekeepers, and the reason is, of course, because even the SEC realizes that alone it can't enforce the rules of its publicly traded companies. It's basically an admission that it just doesn't have the manpower, it doesn't have the ability, doesn't have the effectiveness to do that, so it relies on gatekeepers. But basically, gatekeepers can be sanctioned. And basically, its sanctions ensure that gatekeepers' incentives are aligned with the public interest rather than serving the interests of the clients that pay them. That's a whole issue. In other words, if you're an attorney working for the corporation, even as an outside advisor, if you're supposedly an independent public accountant, how can you be independent of the company that you audit when it's the company that you're auditing that pays you? And I've written a number of series of articles on whether commercialism and independence can coexist. And I take the position that's actually a flawed concept. But basically, what the SEC does in their enforcement procedures is they look at the auditor as gatekeeper, and that they say, Mr. or Mrs. Auditor, you're required to sign off on the 10K. You're supposed to certify the accounting is done according to GAAP, which is generally accepted accounting principles. And we have a whole session on GAAP and non-GAAP, and anti-GAAP and not GAAP, but we'll talk about that a little later. And that the audit must be in accordance with generally accepted auditing standards. And we'll talk a little about that too, because what is generally acceptable to one may not be generally acceptable to another. And unlike law, which is case-based, accounting is rules-based. And as you know, if there's 200 rules about how to handle the same thing, they're going to be very, very different. So what's interesting is the auditor has certain liabilities. If they are primarily liable for a failed audit or they commit a securities fraud, the SEC says we're going to level fines against the auditors. And I think if you look in the Wall Street Journal, practically every day you're going to see fines leveled against the auditors. In fact, the big audit firms, the top four, basically are uninsurable, and they self-insure because their risk of default is, as a strategically important financial institution, it's just way too great. So let's go on then to, and I gave you a copy of the proxy statements because I think you'll get a real kick out of this. I shared my Oracle proxy statement with you. And basically, if I want to receive the total copy of the proxy, maybe, 20 pages, 50 pages, 100 pages, I have to put in 16 numbers, which is located on the following page, they advise me, and go to proxyvote.com. I can request a copy of the proxy by email or by paper, and I have to send it to them, of course, giving them the 16-digit phone number, and I also have to do it by November 2nd. But if you take a look at the proxy statement, now understand that I own shares of Oracle directly. I don't own them through a mutual fund, which is the way most people, the 80 million Americans, maintain their stocks and never even receive this. But look what I'm asked to vote on. The Board of Directors recommends you vote for the following proposals. Advisory vote to approve compensation of named executive officers. They don't name the executive officers. They show the election of directors. Of course, Leon Panetta, didn't he not balance the budget of the federal government? He's one of the directors. Ratification of Ernst & Young as an independent public accounting firm, and that you vote against a proposal regarding lobbying. Actually, lobbying report. It's that they identify how much money they're spending in lobbying. And they say that we really don't want anybody to know that. And this is it. And whether you vote or not doesn't really matter, because most of the votes are held by the Fidelities and the Vanguards, who have $4 and $5 trillion of your mutual fund assets. And they exhibit, I think we'll see later, 98.3% of the time they vote in favor of the stock compensation, the executive compensation, both of the board of directors and the shareholders. But I wanted to take a look at the modern corporation from a perspective that goes back many, many years. I thought I'd read, there was a distinguished Harvard economist that was very troubled by the emergence of the type of corporation in America that was being created. It was 1911, Taussig, this distinguished Harvard economics professor, observed, and diary forward basically 120 years later and see if this is not the case. The concentration of control in a few hands shows itself most strikingly in the United States. Though we have been singularly reluctant to concentrate political control, we have been unhesitating in the acceptance of a concentrated industrial control. It is odd that in England, where unification of responsibility has been carried to the maximum in public affairs, directors still direct in industry, and the powers of presiding managers are still strictly limited. In the United States, where the tradition of checks and balances continues to shape political organizations, of course that's arguable today, directors in great corporations are often no more than figureheads, while presidents are benevolent despots. This development of one-man rule has no doubt promoted boldness, efficiency, progress, but has also concentrated power in a degree to justify unevenness. So then let's move a little forward to the modern corporation's formation in a book on by Hamilton and Micklewhite, who argue in Greed and Corporate Failure. The act is played out many times before. Remember, we went back to the Model Business Corporation Act to see where the strengths and the weaknesses of corporate control are. Enter the CEO superstar. A dominant CEO who emerges packs the board and the company with like-minded executives who owe their position to him and are reluctant to challenge his judgment. The dominant CEO may begin, perhaps unconsciously, to behave as though it's his own creation, as Kozlowski did at Tyco, Ebers at WorldCom, Tanzi at Parmalat, use it as their own piggy bank. That is when shareholders and the board become irrelevant. It's actually not true that the board becomes irrelevant, because the CEO generally heads the board, and also heads the executive management of the company. I think what's irrelevant is the independence, the separation of duties, and the oversight of the board of directors. I'd like to talk a little about the article that I gave you about CEO Stump forfeiting $41 million. And what I find, what's fascinating about this, okay, the public is of course outraged by this fraud that was perpetuated by the CEO of Wells Fargo. And the board, of course, says that, wait a minute, we never knew anything about this, which addresses two issues. Number one, whether they're lying, or two, whether they knew about it and were complicit to it, and three, whether they met frequently enough to talk about it. But I could assure you that the compensation plan at Wells Fargo of the board was identical to the compensation plan of its CEO and head of the company, Mr. Stumpf. More so, the board expresses outrage because basically the public expresses outrage. but I would suggest, and arguably in the postmodern corporation, the board and the executives are the same. And I think to back this up was an article that I, from a colleague, Gretchen Morgensen, September 23rd, 2016, your mutual fund has your proxy. That basically, in the Stump case at Wells Fargo, Vanguard, Fidelity, and all the other major mutual funds voted in favor of the stock compensation plan, both of the CEO and its board of directors. So all their goals were aligned. So the fact that the board was shocked by this is patently absurd. The other thing which is tremendously interesting is when you think of the 80 million mutual fund holders in America, that all your pension plans are in many of these mutual funds by the Fidelities and the Vanguards of the world. They are the voters. And as I mentioned before, 98.3% of the time, they vote in favor of the stock compensation plan, both of the directors and the board. I think you'll find this article tremendously interesting. The other article, which I thought you might find of interest as well, is the article about Goldman Sachs and Facebook, and how because of some ridiculous SEC rules and the fear of prosecution, the attorneys within and corporate counsel within and outside counsel within the Facebook family refused to sell a number of their shares to Americans. And it was because of some, the SIVs, the special investment vehicle issues that were part of the offering. I don't know if you have time or can go into the detail of the U Chicago study, but it talks a little about the structure of corporate ownership in America, where ownership is most concentrated in smaller individuals. The conclusion I think it reaches is that regardless of the concentration, regardless of the ownership, the concept of acting in the best interests of the shareholders just doesn't appear to be terribly relevant today. And in fact, the best interest of the executives seems to be paramount. So this pretty much ends up our first session on exploring the postmodern corporation. What you'll see later on is that some of these issues that we're talking about today have extenuating consequences, in relationship to practicing an ethic of sustainability and acting as a sustainable, ethical corporation to create value as opposed to create profits. We'll talk about that soon. Thank you.